Welcome into the show, Anthony Scavo. How are we doing today?
Uh, Pretty good, Matt. How you doing?
I'm 6 feet above ground, so I always count that as a good day. We are, actively working through a lot of projects right now, and obviously navigating a lot of the challenges that the market has. Also, obviously, opportunities depending on how you look at it. I know you guys are, very active in the commercial real estate and development space. For those that maybe don't know about Basis and what you guys are, what you do, give us a little bit of insight.
Yeah. So basis is we have two basic verticals. We build and develop self storage buildings. That's where call it our bread and butter started at. My partners have been doing that for 20 plus years. When they brought me on in early 2021, late 2020, it was really to run the self storage development pipeline that we had and to rebuild what they exited out of. Right. So as everyone, I'm sure a lot of you guys know, the market's a little tumultuous right now and things started changing. Construction costs went up, land pricing was going up, interest rates were going up. When you have those three things, development becomes harder. And we were just noticing that there was a lot of opportunity in buying existing, they were calling them mini storage, half storage, whatever you want to call it, but they're basically flex multi-tenant industrial properties. So we saw that opportunity. We verticaled into it in late 2021. We started buying these properties in 2022. And as of the end of August, we'll have about 4 million square feet.
Wow.
So yeah, we went pretty fast. We were getting the same kind of yields that we get in development and cash flowing assets day one. So it was a pretty safe bet, we felt. And thank God we found a lot of people interested in taking that journey along with us. When I say people, equity sources.
Got it. No, I know we'll talk a little bit more about that in terms of what your guys's, kind of deal buy box looks like, what your ownership and management box looks like, and obviously, sourcing of funds and how you guys are acquiring and, getting those yields. Maybe you can reverse back a little bit, for most of our listeners, some of the most insightful nuggets often come from that, founder to, being a real business journey. And Basis has obviously had a very cool story. So maybe bring us back to the beginning of how, Basis was incepted and founded and what the, early stage growth looked like for you guys as real estate investors and developers.
Yeah. So I have three partners and myself. My partners, Steve Garchek and Jay Massaman, they met, I think, in like 2009, 2010. They both, Steve just moved down to the South Florida area. Jay's been down there his whole life. He went to all this, basically a Miami transplant from Boston, but he was down there before the big migration started. So they met. Jay was a former CBRE broker, like one of the best they had. He went into the private industry. Steve was a developer. He saw Jay as a guy, to help them find buildings, and they had a pretty fruitful partnership. They built about, I think, 15 self storage buildings, all in true urban areas: New York City, Miami, LA. They did that from 2012 to 2020. They exited everything in 2021. And my partner, Dan Weinstein, joined them a little bit before I did, about a year earlier. He came from public storage and from a fund he raised before them, and was basically doing the same thing. And the three of them brought me in about a year after that, and that formed the backbone of Basis.
And what were you doing prior to Basis?
Oh, I worked for two of the largest families in New York. First was the Lefrak family, and then I worked for John Katzmatidis at his place. I was at Lefrak for 26 years. I ended up in charge of their development and construction. So they're like, I think, the third or fourth largest family-owned real estate company in the world. I was there since I was 17, working through college and everything else.
So how did they find you when you were 17 years old, and what enticed you to go and work for this family?
My dad worked there before me 55 years, and he brought me. It was supposed to be a summer job, and it ended up as a permanent job.
Yeah. Now, what are some of those, wealthy family offices, wealthy development companies, and really just smart-minded, smart money, wealthy, investment groups doing that some of these early stage investors can foundationally learn from as they start building their own investment portfolio or company or career? What were some of the things that you've carried through with you over to Basis?
I mean, I think the biggest thing to learn out, I'll make some of your listeners laugh. I mean, when I was going to business school, and because of the relationship my father had with them, they let me work in there. It was like family, but they didn't call it a family office back then, right?
Sure, right. Yeah, that's a new term.
They didn't have that term yet. It was like, it was basically, a lot of the high net worth people in New York always had some investment people that worked for them, just it's a good way of using your money, keeping it active while it's sitting there, right? So I worked in that part of the company for about 6 months during college. It was great. I went to business school and it was interesting to learn that. But I think some of the biggest things you learn from that, because they already built their wealth, it's they have the luxury, but it's also the right thing to do, to be patient in certain markets, right? You can't jump in too early, you can't jump in too late. And if you miss the ride, then you just stay out. You can't, that's a big thing to learn from all the big families in New York, the ones that are still successful, because that's what they did. They would not build when it was, everyone else was building. They would build when people weren't building, because they would get better pricing and they were able to beat the market out of a cycle, right?
Yeah.
And listen, the problem with everyone in real estate today, and even in finance today, I would say, right? They don't know cycles because they haven't lived through them yet. It used to be very cyclical. Like people, you would go 5 or 6 years, maybe 7 years, you'd build, you'd buy stock, and then there'd be some kind of recession. And the recessions were quick and they weren't horrible like the one in 2008. But what you had was in 2008, when you had this huge, totally market-changing recession, right? And you had government step in and not let the bottom happen, you never went out fast. So it was the recession, instead of being horrible for 3 or 4 months, it was bad for 2 or 3 years. And then you had a slow growth coming out of it instead of a fast growth coming out of it, because pricing never really went all the way down. Right. So you had an interesting thing. Listen, people could say that intervention stopped, really bad things from happening, but it also probably stopped it from getting, pricing getting to where people, advantageous investors would have came in and took it out earlier, right?
Yeah.
So it was a very people don't remember that, because a lot of the people that are ruling the economy today weren't even probably in high school then, so it didn't affect them as much. So it's a little different, and people haven't seen those cycles. That's why I think everyone's so worried right now in this time, right?
Yeah. I mean, it's an interesting, because when and I'm assuming you're talking about the 4 kind of quadrants of an economic cycle, right?
Yes.
And depending on what type of asset class we're talking about, and depending on, I guess, what kind of market. Because obviously you could maybe give it a macro label, but also I think there's a lot of micro economies and assets that might be in different parts of the economic cycle or what phase we're in. Does it feel a little bit different to you this go around than in previous market cycles, or how do you communicate that to people that are maybe saying that narrative or buying into that narrative? What are your thoughts on that?
I mean, it's so much different now. I mean, I'm not that old, but I was, I grew up with a lot of older people, and I grew up through a lot of cycles, and I'm older than the people I work with, right? So, you become like the elder statesman to them, and you try to explain like, this is not new. It's happened a lot of times. They just never seen it.
Right.
Everyone's just seen growth. No one saw any like compression and then regrowth.
Yeah.
So the difference now, why it's so much different than what I feel like in different economic downturns and cyclical actions, where there's so much money sitting on the sideline now.
Still, right?
Still,
a lot of people think it's ran out.
No, there's more than ever. Because you got to remember what the Fed did from 2008 and COVID, relaxing the interest rates in their policy, just flooded the market with cash. Now, listen, I'm sure we could say it mostly benefited really rich people. It did. Listen, that's what happens. Yeah. They have more money, so they can make more on interest, and that's what happens. It's not. I'm not the person that says that's bad or good, but that's whatever. Whenever you relax monetary policy, it's going to affect the people with the most money more, just because it's a multiple effect, right?
Yep.
If you have $1 million, you get 2. If you have 20 million, you get 40. It's a big difference.
Yep.
Right. So, and then what happened was you saw it before COVID. they were about to start tightening and raising rates anyway because they saw something happening. They're like, there's too much money. We have to fix this. But then Trump got elected and he had COVID. So he's like, oh, well, let's push growth more, right? And I think doing that, you flooded more money. And now when inflation going up higher than the Fed wants it to, which is just a made up number anyway, they made 2% a year. It doesn't mean anything, but whatever. Mm-hmm. But people forget, I'm not trying to be an economics professor, but when you take a long time ago after World War II, and they took in the 60s and 70s, when they took America off the gold standard, right? When you do that and you take money off something fixed that's measurable, you just get growth.
Yep.
Now, growth's inflation, right? People want inflation, but you don't want it to go so fast that a cheeseburger is $500. So that's where you have to balance it. That's what the Fed balances with interest rates. But I think they were a little too late to raise the rates, and that's what you're getting now.
Yep.
But that doesn't take away all the cash that was on the side. And that's there. I mean, people have, these fund managers, you see it every day in the news, like Blackstone, BlackRock, they're breaking records, the amount of cash they have on hand. The problem now is the guys with the most money are happy with low yields. So they could buy them treasury bills and get 5%. Mm-hmm. So why are they going to invest with me or you or anyone? So that's what a lot of the core money people are happy about. They're like, oh, BlackRock's making their fees. They're buying treasuries. It's fine. And it's very safe. They'll never lose money. So I think that's what people aren't getting right now. And that's what's happening. And I think whatever happens when the Fed drops the rate like 50 basis points, you're going to see inflation go crazy, growth, the stock market, everything, because people are so like ready to have some good news and relief that they're going to explode into investing.
Yeah.
And I don't know if that's good or bad. That's what I'm worried about, because then you might have the Fed again react too much and that's something else. Not to keep going into this, but I mean, I would have raised the rate 200 basis points in a day and ripped the Band-Aid off instead of what they were doing, because that just made it worse, And that's the problem with our government. Everyone wants to listen, no matter when you raise rates, people in the economy, finance guys, traders, people who handle money don't like it. Everybody wants to leverage their money cheap as you can because you'll make more, right?
Of course.
So that's just simple math. But you do that and you don't raise it fast enough, you give uncertainty, which is much worse than raising rates.
Yeah.
And that's what they did. People don't like uncertainty. They like certainty. And I think that's the problem.
Well, we've got at least, I know the last futures statistics of a September rate cut, I think was right around 92%. Looked like the market talked about baking in maybe a second and a third rate cut potentially still this year. Some people are saying they don't know. But let's just assume, right, that they're gonna cut rates and start to ease a little bit. You've talked about this in terms of, what are the benefits to real estate investors and developers like yourself and other individuals? And what are some of the, double-edged swords that they got to be careful of, that they should be watching out for, that you guys are paying attention to when that happens?
Yeah. I mean, I'll take the benefits first, because they're easy. The lower your cost of capital and that, equity partnerships, whatever it is, the better it is for a real estate investor, right? Because you could, number one, you make more money. Number two, you could take deals that maybe are a little bit on the edge that you feel are good, but you don't want that much negative leverage on a deal because it just kills the deal. So you could always get a little bit more risky. And listen, growth is based on risk, right? You take risk, you'll do better. The problem is when rates are high, you can't take as much risk, and a lot of deals aren't trading. And it's also, I also think you're going to save people who probably in the multi-world, in the world that didn't have high yields, they're always trading at low cap rates. You give them a chance to get out of properties that probably were decent deals that just were at the wrong time, and you're going to need that. You're going to need some kind of stability and lower rates to get some of these people out of the deals they're in. The bad thing is what I brought up before, is that you don't want to cut and then everyone goes crazy and then inflation goes up again and then they're going to raise it again, because then you start getting into that like a back and forth cycle, which is worse for everyone.
Yeah.
They want to do it the right way. Wait. Then you should always raise slow. You don't want to raise, you want to drop slow, not raise fast, drop slow. Yep. You want to keep that stable. But I think he's been pretty cautious. I mean, the Fed himself, Powell's been cautious, maybe too cautious, but I mean, I think they'll do it slow. I don't think he's going to go fast. I think it'll be a quarter basis point, every meeting or every quarter. And I think till he gets what he feels is stable, like a real rate. Because I think what they made the mistake was, and I think he realized that you can't go below like 2% or 2.5%.
Yeah.
I mean, there's got to be some cost of money. And yeah, you could do that in the case of emergency, but an emergency doesn't last 15 years.
Yeah, we're not Japan. We can't afford to do that.
I mean, they basically had to think about it. They had it for like, almost 15 years. It's great. That's a long time.
Yeah.
I mean, they should have let, and people don't remember. I remember the first time I was going to university, college, and I was reading like the Fed dropped it to 4.5%. Everyone was like, "Oh my God, it's amazing! It's the lowest rates in 100 years." And that was, think about that. It wasn't that long ago, and that was the lowest ever. And now they're talking about borrowing at like a quarter basis point.
Yeah,
like there's got to be some reality brought back to the world.
Yeah, people have gotten pretty spoiled over the last, let's call it 12 to 13, 14 years, like you said. And there's really no context to that for a lot of people, right? So you're the way you act, the way you move, the decision you make or don't make oftentimes is, made in a bubble versus actually taking that macro picture like you're talking about. So let me ask this then, based on this last 18 to 24 months, which has been a more challenging time, like you said, right? To get deals to pencil, the engineering of the economics and the yields that, investors are looking for, sellers are looking for. It's been a challenging time to play Tetris and finding ways to make it a win-win. But you guys are still doing deals. You guys are still making stuff happen. So in a high interest rate environment or in a high construction cost or labor cost or, supply chain restricted type of, a lot of the headwinds we've seen developers face over the last 2 years, which, has made it really challenging in a lot of ways. How do you guys navigate during times like that? What allows you guys to stay nimble, still find yield, still keep cash in place, still keep investors, engaged? What does it look like for basis over the last 2 years for you guys?
Yeah. So we did a couple of things, I think, differently. And listen, the stuff we're buying is also probably one of the fundamental parts of the market that still have yield, because you're buying stuff that historically rents were very, very low because it just was a sector that no one really concentrated on. And listen, the only people that really made big headwinds are like, Blackstone bought PS Business Parks, things like that. Those were the big transactions. There aren't that many because it is very management intensive. And it's very granular, right? So you have to be really into details with the tenants. We have 1,000 tenants in 3 million square feet right now. When we have 4, we're going to have about 1,500 tenants. That's a lot of tenants. It's like, it's more than multi-portfolios. Think about it, right?
Yep.
And you're dealing with that on industrials. That's why we have yield. And a lot of stuff we're buying, is 20% vacant in a market that should be 4% vacant. So we can fill up vacancy fast, grow yield as long as we put some money in. I think something else that we're doing that's different than everyone else, because it does hurt the sponsors and return a little bit. We raise the money up front for all capital work. So we're not doing capital calls. Because of the way the market is right now, we realize that's a touchy subject for people. Even if it is for capital work, it's better to call it up front, raise it up front, we hold it, we manage it, we put into the property. And for and our budget, we haven't had to do a capital call, thank God, yet on any of our properties, and we don't want to, right? That's one of the things. For our development side of the business in self-storage buildings, we only had 2 loans that were in that, call it, historic to now time when we were going to run out of interest reserve. And we bridged them out before we had to go for a capital call with another lender. We refied them out as we finished the buildings because our buildings were finishing. So we didn't have any that we didn't finish before an interest reserve right now, like some of the you hear about that in development.
Yep.
We didn't have any of that, thank God. And listen, self-storage buildings are pretty inexpensive to build, and they're always worth more when you finish them. So you're always okay as long as they're in a decent market. So I think just because of the sectors we're in and the way some of it was timing, some of it was just our management of the money, I think we did better than most. And the new stuff we're buying has the yield that you could take higher debt on it and it still works.
Mm-hmm.
Also, I think the lenders see the potential of the stuff we're doing, and the spreads are much lower than other sectors.
Yeah.
So we're getting a benefit of that as well.
talk a little bit about your, I've heard that, self-storage, industrial, they've kind of, they were the hot darling child for a while. Now they're, kind of coming to the tail end of, their run. What are your thoughts on that comment? And what are you guys looking for right now in terms of mitigating risk, for your overall portfolio?
Yeah. So when you hear industrials, that used to be that's big box industrial, right? And they're absolutely right. People overbuilt that everywhere. And listen, a lot of the guys that were doing aren't dumb guys. They were just like, I could build a 1,000,000 square foot building for 50,000 square foot. The second one's going to cost me 40. Why don't I do it?
Yeah.
Right. It was very cheap.
The economics made sense.
And it penciled out even one tenant.
Yep.
So they're like, why don't I build two of them? But they only have a tenant for one. And that's why you're seeing that huge vacancy. In some of these areas, they overbuilt these 1,000,000, 2,000,000 square foot buildings like crazy because there was such a need for them. And that's why there's so much inventory of that. There really isn't that story in multi-tenant industrial. And Matt, you gotta remember, when I say multi-tenant industrial, I'm talking about little tiny suites, like 2,500, 3,000 square feet.
Yeah, your
like,
neighborhood contractor who wants an office for him and his admin, and he wants to store his truck and some tools there, right?
Exactly. There's no place for that. There's none of that available. Trust me. You can't find that around.
And you think you guys, your investment thesis or theory is that there's plenty of runway and demand for that going forward?
I think there's plenty of runway and demand for that where we're buying it in the Sun Belt because people move down there, right? Listen, it's the story. You got COVID migration. Those states are growing. You can't build this because it's too expensive to build. No one wants this because no municipality wants 50 tenants in one park, right?
Yeah.
And all this stuff, you have a lot of barriers to entry. You have this moat, right? You can't get into the moat because you have zoning problems, you have barriers to entry, you have cost of construction. So the only thing, and for some reason, thank God it hasn't been institutionalized yet. We're trying to do that. And if we get enough scale, we probably can. But it's very management intensive. That's why we built out the management company when we did it. So that's base space, our management company. And we built that out because, listen, in self-storage, we have extra public, right? We only use them. They're very good at it. You can't, listen, if there was someone as good as that in small bay, they'd be doing that for us.
Yeah.
Okay. There wasn't. So we decided to do it this way. And that's mostly our company. So that's why I think industrial, what we're doing is a little bit more protected than what you heard, but the big box was overbuilt. And again, I don't fault those people. I don't think they were dumb. I think I would have done the same thing if I could build a building. If I could get another building for basically, and it pencils out in the same cost, why wouldn't I build another one?
Yeah.
And a lot of them were getting those prices, especially when they started this in early COVID when it was cheap still. And they're like, why wouldn't I do it? And that's where all this inventory you see now that's vacant was coming online now.
Yeah.
And self-storage has some issues, right? In certain areas. I think what we're building it because, some of the sites, it takes us 3 years to get even approved, Matt. Mm-hmm. So we're in areas that no one wants to build in, but they need it.
Yeah.
I think that's why our thesis works a little better. But if you're building in where you see 5 self-storage buildings, I think it's a little overbuilt as well in those areas. We're not doing most of that. Most of the stuff we're doing is in a town where they outlawed self-storage or where you got it right before the line, or it's so hard to do a development. No one's going to spend the money to do it like that, like those areas we're in.
I want to talk a little bit more about where you're extremely bullish right now and kind of where you guys are heads down, pedal to the metal on. And maybe also as a follow-up question to that is talking about where you see, whether it's in your guys' particular lane or not in that, bullish sentiment, other areas of opportunity you think smaller investors and individuals might, want to spotlight and maybe take a second look at and see how that might potentially tie into their investment thesis as they go forward.
Yeah. I mean, we're definitely bullish on, and I think a small investor get involved in the Orlando to Tampa area, that whole row in Florida, the I-4 corridor from, call it 20 or 30 miles west. I mean, east of Orlando all the way to the Tampa coast. We love that area. I think the growth there is enormous. People don't realize it because South Florida overwhelms it all the time because everyone's looking at Boca, Miami, right? Mm-hmm. And listen, that's a great area too, but the price per square foot, they're already caught up to. Yeah. You're not going to, I don't see how anyone's modeling works in the Miami area when they're saying you're buying it for $250 or $400 for $500.
Yeah.
There's going to be a point. It's not Manhattan yet. I mean, that's not
Right.
happening, right?
Yeah.
There's only a couple of places land constrained. There's someplace in the Northeast where you see those crazy numbers.
Right.
Right. Miami's not there yet. It will get there, I think, sooner or later. But I mean, that's my problem with really South Florida, but that's another great area. And I think the whole Sun Belt, like little pockets of that, are exploding too, because people aren't moving back. They're not going to listen. No matter what. Look, I'm from New York. I grew up in Brooklyn. I lived in Manhattan. I live in Westchester right now. I love New York. I'm like a diehard New York guy. But I understand why you moved to Florida and live there, because you get a better quality of life. It is a little bit more expensive now, but you'll get much more bang for your buck.
Yeah.
It's just the truth, right? And even Texas, like, you go there, you get a big house, you get a nice you get nice food, nice stores, everything. And all these areas are, listen, there's nothing like Manhattan. We have like 50 different restaurants of every ethnicity in the world on one block.
Right.
But they all have their little scenes that are developing, and it's really cool what's happening. They all have their little downtown, and all these little areas are like, because that's just the way the world is now. Mm-hmm. They all get pockets of people move in, make it a better place, make it cooler, and it's really happening. I think it's amazing what you're seeing in those areas, and I think there's going to be a lot of opportunities for small investors if they want to invest with their own money or go into a fund maybe or something like that, because there's going to be opportunities soon. Because a lot of guys are over their skis in some of these developments, and there's going to be opportunity because, listen, I don't understand. I remember when I was a kid, I used to see like all these developers come out of nowhere. I was like, how are they a developer? You need money, right? And listen, there's ways to do it in certain states. Like, for instance, I bet you, I don't know if your listeners know, like in Florida, to build a condo, right? You could start selling the condo and use the deposit money to build your condo. Did you know that? And, I mean, that's only Florida. New York, you can't do that. And New York, you got to keep everything in the bank till you close. So it's a totally different thing. So if you're a good salesman, you could be a condo developer.
Right.
You build a beautiful sales center, you sell everything, and now you're a developer, right? That's why certain states have these people that could come out of nowhere and become a big developer. You could do 2 or 3 condos, and you could be almost like multi-millionaire. It's on just your promo. It's a great business, but that's when interest rates are very low, and you could borrow the money. Your construction loan was 3 or 4%. Now your construction loan is 10%. That's a big difference.
Yeah.
And the longer it takes, that 10% is becoming more and more and more.
Yeah.
And time's always a killer when the rates are higher. So I mean, people don't realize that. I think that's what's going to bring a lot of these opportunities back, because you're going to see people going in to buy them for discounts.
Yep.
When they see opportunity, they're going to redevelop them, and you can get into a fund that someone does that, or if you want to go buy yourself a small, 2 or 3 family, because those prices are going to come down too.
Mm-hmm.
And that's how you start. Listen, you buy a couple of those, you refi them, you take the debt out, you buy more.
Yep.
You can become a decent developer.
Is definitely it takes some time for that trauma to trickle down the tree, right? But it's, as you said, opportunities coming, and I know we got practically almost $1 trillion of real estate debt coming due over the next few years. Obviously, that's across a lot of different asset classes. Office being, kind of the big focal point right now. I'm just curious. I don't know if you guys are going to play in that space or not, if you see any opportunity for redevelopment, or repurposing a lot of those spaces. But what do you think is going to happen in that, in that sector of the commercial industry? Yeah,
and this is not about basis. So at LeFrak, I actually did convert an office building into an apartment house. We did it a long time ago, before like anyone was talking
when the
about
economics made sense.
Yeah, it just was. It also wasn't a good office building. There were some office buildings that shouldn't be office buildings.
Right. Yeah.
Because they used to stick them on like these blocks in New York and Queens and Brooklyn that really don't fit. Like they're not a good place for an office building. They're in the middle of a residential area and there's an office building, right?
Yep.
So some of those probably do make sense to convert, but I'll tell you something. It was very difficult. Office buildings were built as office buildings, not to be apartment houses. Okay.
Right.
So there's no holes in the floor. There's no air shafts. There's no duct shafts. There's no, people don't realize that there's not a bathroom every 2 feet.
Yeah.
There's a lot of things
hard you can't just on a piece of paper change it from office to bedroom, right? It's not that easy.
Especially if it's a big office building where it's too deep to put to. What do you do with the rest of the area?
Yeah.
So you can't have an apartment that's 80 feet long. It makes no sense.
Yeah.
Sooner or later, you have to have ones that fit into that world. So, all the stuff you hear about, they're going to green light the zoning to make it if it's an office building, that probably shouldn't have been an apartment house anyway. If it's a true office
and that's
building,
just one small component of it, right? I mean, in my
yeah,
opinion, the government's going to have to come in and subsidize making this make sense
yeah,
for people to want to take the risk, take the time, spend the money, just to be able to start the construction process to see if, they can do what they say they can do theoretically on a piece of
yeah.
paper, right?
If you're in a valuable enough area, Matt, like sooner or later someone will come in, right? Because they're gonna be like, I'll take a shot. It's cheap enough now. Like, when prices go down, that's what's gonna happen.
Sure.
And that's why, I mean, I don't want to sound like a true American, like, the best of America, but we're the only country in the world that has that, like a true
right.
It's as free as it could be with us,
Yep.
So sooner or later, it's gonna drop enough and someone's gonna say, that's cheap enough for me to take a chance and get interested, right?
Yeah.
So, I mean, I think you're going to see that. And I think some office buildings in really weird areas, like, or bad areas, are going to sell for like the price of the land.
Yeah.
And they're going to scrape them down and turn them into something else. And listen, you got to remember something else. If you're in the middle of like a true, nice urban area, you could take out a floor, make a basketball court on one, do something. And because they have a lot of loaded office buildings. And I think a lot of that, you're going to get into that more of, that's the big thing now, to get into entertainment that you're involved in.
Yeah.
And I think you're going to have a lot of that. People need those big floor spaces, things, that's just the way the world is.
Yep.
I mean, when, I have a 7-year-old and a 3-year-old, right?
Nice.
Everything they do is immersive. There's no more like us, like, go drip, here's a ball, leave. Like, there's no more. You got to have like 20 people playing, a coach.
Yeah.
It's like, there's no more by yourself with a ball and you go to a park in New York.
Different times.
No, there's not. That doesn't happen anymore. So, I mean, I think a lot of that's going to happen. And listen, office buildings are good spaces for that. And listen, people still need places to meet, right?
Yeah.
So I think the WeWork, office suite concept is working. And I think if he started a couple of years later, he probably would have been in a better place than the guy was, now, and all that stuff would have been different, because now that's all people want is small, like, offices.
Yeah.
And I'll give you a perfect example of something we own. So one of the parks we bought came with 2 office buildings. We didn't have any choice. We bought it. We love the park, right? The office building that's split into small suites, 100% occupied. Rent's growing 7% a year, no problem.
Yep.
The one that was big tenants, empty.
Yeah.
We're in the process of making it suites.
Yep.
So I think if you have, 4,000, 3,000, 2,000, like little office suites, you'll be fine. Mm-hmm.
Yeah.
I think that's always going to be fine, because listen, you're a solar company, a carpentry company, a GC. You need an office.
Yeah.
You need someone to answer the phone, do paperwork in, have your accounts receivable. There's got to be someone working there. And if you have something small that isn't, cost you, I don't know, 50,000 a year. So, whatever that is, right? You talk about 4,000 a month, that's your rent, 48,000. That's doable for most companies. They're like, okay, that's our expense. I don't want to buy something. I don't want the headache of owning it. It's a full service building. They're taking care of my air conditioning, taking care of my cleaning. And I think that really works. But the problem is, it's a lot of money to do that to a whole building.
Yeah.
It's not like, I'm talking about a 2-story office building in a park where we're making money already.
Right.
If you're in a 50-story office building,
that's different.
It's a lot of capital. It's not like doing a little, like, we're doing it phases, so we rent, we could do that. I mean, I don't see how you're going to do it in a fully, like, abandoned Class C office building from the 50s. Right.
Well, I am hearing and seeing the same exact thing, which I'm pulling out of your kind of talking point, which is smaller footprints. People don't necessarily want to take on that level of risk. And if they do want to, right, they're probably going to now start easing into it after this post-COVID trauma, that so many people had, kind of getting caught with their pants down, right? And so I think, this idea of either smaller footprints, and I'm even seeing it on a lot of my retail buildings where, our 20, 30,000 square foot spaces, they're going, we want 10, we want 7,500, and so I think overall the smaller footprint is a way to take up some of these, bigger spaces, chop them up into something a little bit more palatable and digestible for people, financially and operationally. And that's a great model to, mitigate some risk, spread some of that risk across, your portfolio a little bit instead of having it all absorbed into 1 or 2 spaces. Now, on the front of what kind of deals and opportunities as we kind of, head into the tail end of the conversation here is, what do you guys got on the docket? What do you guys, in a perfect world, what are you guys offering out right now? And what are your investors seeing and enjoying? And what do you think maybe the next 12 months looks like, from a pipeline horizon for you guys? And will those economics be shifting at all or staying the same?
So we have 1.1 million square feet on the contract now. It's due to close the end of August. We've had that on the contract for a while. We've been extending it to raise capital, get the deal right. I think you're going to have a lot of price cuts going into the world. When you see what's happening, especially if the NOI is going down as you're on the contract. I think that's going to happen a lot, and rates go up. You could have a lot of listen, and that. I mean, people used to say you don't want to retrade people. That's not a retrade if they're not doing well on the project. I mean, that's their fault.
Hey, the numbers are the numbers, right? That's the economy, not you changing or sweeping pulling the rug from underneath somebody.
Or someone's losing tenants. That's their fault. I mean, they should be trying to retain them when they're under contract. And I think things like that are you going to see. I also think, but those we've had historically in the contract. So I think we'll get those closed. Our goal is to do another 1 million square feet before the end of the year. We're going to try, but only if the deals are out there, And I personally think right now, Matt, everyone's like, till the summer's over, what just happened with I don't want to get into politics, whatever happened just with politics, what was going on even before that happened, now this happened, people are nervous. They're like,
they're kind of waiting to see who the hell is going to be on the ticket, who's going to be our president,
if they don't have to sell, they're not going to put it on the market right now. Totally. They're going to say, they're going to take a breath, wait till September.
Yep.
I think if you see shifts going a certain way, they'll do one thing. If they don't, they'll do something else. Mm-hmm. And then after, I think you're going to have a very active October and November. And I think they can't sit on money this long. You got too many fund managers that aren't getting paid. Yeah. You got too much money sitting on the sideline. You got too many people that are holding on to deals longer than their modeling showed. And their investors are all saying, when am I to get money? Yeah. So something's going to have to happen. And then if you wait till December, January are dead because of the holidays. So then you have nothing. So then they have to wait till next year. And now you're into Q2 2025. That's a long time. Yeah. In our world, that's a long time.
Yes, so, is.
They're going to be like, I think you're going to have a very active like Q3, early Q4 2024. You have to.
If let's say you're a small investor or maybe a small investment group, and you're looking for opportunity. How are you guys building relationships right now? How are you guys coming across opportunities? What's been your bread and butter for how you guys are, creating that deal flow and finding things that actually kind of break free of the run of the mill, boring stuff that most investors aren't looking for, that every once in a while you come across one and you guys are under contract now on 1 million square feet later?
Yeah. I mean, a lot of it's history, right? We close on 20 deals in 2 years. So the brokerage community in a whole sees us as reliable buyers, right?
Yeah, that's a big deal.
That helps a lot. I think it's also personality. You're a friendly guy. If people like to deal with you, it's good. No matter what anyone says, it's not just about money. It's not if you're easy to deal with and you're fair. Yep. People flow to that, and they it radiates, and then people come to you because they want. Yeah. They're like, these guys aren't bad. They're fast. They don't bother us. They're not problem makers, and they get deals done, right?
Yep.
And that's the relationship we got over the last 2 years, which is great. I just think there's a lot of stuff out there, but you have to be selective too. You can't just, because it's so tight right now. People are like, "Oh, this deal's great." I'm like, "Is it great because it's now, or is it great because it's a great deal?" Right?
Yeah, absolutely.
You got to ask that, and sometimes you have to step back, breathe, and just look.
Yeah.
And listen, if you see something, people don't know what's happening in the markets either because you're still getting that COVID boom. People move there. You gotta look. If you see a little softening, I would pause right now if I was an investor and say, okay, let me just take a couple of months to see what happens. Don't go into that market. Just wait. Have some stuff. Let it season. Let's see what happens, right?
Yep.
Because everyone's used to the big stories about places that are so land constrained and so hot, they always do well. There's only a couple places in the world like that, in the world.
Yeah.
Not in the United States, in the whole entire world. And people don't realize that there's only a couple places, but that's the story you ever hear all these people, all the pundits and people talk about on these shows. Like, yeah, if I'm on 57th Street in Manhattan, yeah, it's going to be okay. Yeah, of course it is. Because it's like, there's no real estate like that in the world.
Yep.
But if you're like in, between Orlando and Tampa in a strip mall, you might say, maybe if I can't lease square footage of this. Like maybe I want to take a Brent and see how it is.
Yep.
Maybe that area, maybe people can only move to Orlando and Tampa, not going to move in the middle anymore. And you have to check that. Like, and things like that is what I think people have to learn about this economy. Really take a breath and look, because things are going to be shifting. You know, it hasn't settled yet from COVID.
Yep.
And now you have all these economic like winds going back and forth, and no one knows how that's going to settle. So you have a lot of stuff going on. And the other part is that, like me and you talked about that messing up. There's so much cash sitting there. People, like even regular working people, some of them have money to invest. Like you're saying, like a small investor. Have you ever heard that before in a recession? Small investor? No, but they have it. So It's an issue. Like, you know, there's something going on that no one realizes, which is good, but it's also it gives less data for people to realize, to predict what's going to happen.
Yeah.
And that's what gets me a little nervous, because there is no data that shows what's going on now.
Well, the data that we've been, trying to make sense of the last 2 years, people are still scratching their head going, this one says that way, that one says the opposite way. Like, which one is it? And, this should say that we shouldn't be here, but we are. So there's just so many things, right, that are conflicting, confusing. Obviously, you got technology in play now. You've got the post-COVID world is just a different world, and it's going to be a different world going forward. I'm with you. I've been of the sentiment that the dust hasn't settled yet, and it's still settling as we speak. And while we can track all the data we want, I think that's our closest thing to a crystal ball. That's usually always 3 months in hindsight. Yep. And oftentimes that doesn't, depict the reality of the situation until 6 to 12 months down the road as well. So I know people are out in our community, in our listenership, always looking at deals, always coming across things, building relationships with people. If you had an opportunity to share what Basis's buy box criteria is, and there was a listener that came across something that fit right into that, what would that be? And, how would those individuals get a hold of you guys?
Yeah. So you can always reach out to you can reach out to Zoe at basisindustrial.com or Ahmad at basisindustrial.com. That's my team. They'll love deals. Ahmad's in charge of our acquisitions department. Our buy box is basically any industrial park that has small tenants, where one tenant makes, the average tenant size, let's say is 100 tenants. If you divide 100 into the total square footage, that's less than 5%, we're good. We'll buy it. That's what we like. We've been, our deal size for our fund is probably around 10 to 20 million. For our big purchases, you're looking for some 25 to 50 million. We try to stay below 50 million, because then you start getting into bidding wars with people that have unlimited money, which isn't great. Those are the deals we lose, and they could pay a lot less they could pay a lot more than we could in return, with returns a lot less than we could take.
Yeah. Their coupon they need to clip is a little smaller, huh?
Yeah. And they need to get the money out. Like we were talking about, listen, you got to remember, no matter what you say about those guys, they only get paid if they're putting money out. They don't make, their promote isn't a lot.
Yep.
This is more about fees and how much they're managing. So it's a little bit of a different business than we would do, but
right.
I get why they want to put money out. And listen, their belief is that time's going to protect everything, right?
Long term.
In 5 years, there's going to be inflation. The property's going to probably go up a lot, and you're going to get a lot of appreciation, and they're still going to do well, which is probably true. So, I think that's it. But you can always reach out to us, info at Base Industrial, Zoe at Base Industrial, Ahmad at Base Industrial, anything else. And if anyone wants to invest too, you can reach out to investor relations at Base Industrial. We'll send you some stuff we have. We're one of the different people. We'll take small investors. We don't care. I know it's a lot more work, but we like opening it up, because we feel if you let someone small and who's young, right, they'll bring 5 more people, and they'll bring 5 more people. You want that. The high net worth big family office we invest in. They want to keep you for themselves more. So it's a little bit different. It's better like to bring in the younger small investors, because that they grow with you, they change with you, and they'll bring more people in and spread the word about you, which is great.
So as we wrap up, and guys, we'll be sure to link all of that up in the show notes at millionairemindcast.com on Anthony's episodes. If you guys want to reach out, you want to check out the website, you want to check out their projects, all that good stuff. That being said, as we close this out, Anthony, I know you have been around a lot of smart people, a lot of wealthy people. What's an investment or life or business lesson or mantra that you subscribe to, that you really have carried through in your career, that you feel has made you successful, and that you believe somebody else on this path to building a business, to building wealth could adopt the same mentality or mindset or skill set that would serve them in their journey going forward?
I mean, I want to be a cliche, but it really is. It's about working hard, and you got to put work pretty high in your. I think today a lot of people put play in themselves above work, and you can't do that anymore. I mean, listen, a lot of people in the world say Americans work too much, right?
Yeah.
I mean, I think the proof's in the pudding, right? That's why America's so successful. I mean, you have to work really hard, and there's a lot of people. I mean, that's one of the reasons why I kept my family in New York, because it's so much driven by that. It's more of that work first, play later culture.
Yeah.
And I think people are forgetting that, especially younger people. You gotta put your, especially when you're younger, before you have a family, you should put 85% of your time in working.
Agreed.
You don't need vacations when you're in your 20s. You should be working when you're 20s. Like, make yourself valuable. Make the leaders in your organization notice you, so they want to take you with them, mentor you.
Yeah.
Get to that point where you're so invaluable that they need you.
Yep.
Don't be a cog. You want to be the wheel. You don't want to be a cog in the wheel. You want to be pushing yourself. And listen to everyone who's older and that's been there a long time, because they probably know a lot more than you do. Okay? I mean, if I didn't work for my dad, I would be nothing right now. I learned everything I did about real estate and construction from him, from the left racks, from working in a family like that, because everyone was doing it for 50 years. It wasn't work. It wasn't a skill. It was just what they did. It was them. They lived that life. My grandfather before him was a bricklayer. Everyone was in that world. Everyone was building a real estate. And that's, sooner or later, you're around enough people like that, it becomes like your life.
Yeah. Check your ego at the door, stay curious, ask lots of questions, work your ass off. And one of my subscriptions in life is the crock pot always tastes better than the microwave. So play that long-term game, right?
That's right. They're slow. Slow is, there's nothing, you don't get anything fast in this world unless you're really lucky. And that always helps too. Luck helps too. Listen, you got to be in the right, some people are very lucky. They're in the right place at the right time, right? And they meet the right person. But, you got to be aware of those moments too. When you meet someone that you want to be close to, do the effort to get close to them.
Yeah.
And I want to learn from this guy. Okay, then show him why he wants to teach you. People don't get that today. It's not like there's no handouts. I know everyone wants that. There's nothing like that. Yeah,
the world of technology and social media that we live in is there's obviously a lot of good stuff to it, but man, that's one of the definite downsides of it, right? Is thinking it's easy. Entrepreneurship is sexy and fun, and man, it's not for the faint of heart. And it reminds me of that one quote, and I'll kind of paraphrase it, but the tail end of the quote is good times create weak men. And when you think about weak men, they want it easy, they want it fast, they don't want to work hard, they don't want to cut their knees and get fall on their face and fail their way forward. And it kind of feels like we're in that season right now, which I think, again, we'll keep politics and the macro picture out of it, but we're seeing a lot of the responses in our world based on weakness right now. And so I think it's that time to lean back in, swing the pendulum back, right? And yeah.
They have to, people, I mean, you got to have a little bit of uncomfort in life. Everything can't be too comfortable, because then what happens? You just expect that forever. And then when something does happen that disrupts everything and puts something really in, you're not ready for it.
Yep.
I mean, the kids aren't ready for that. You're not ready for like a big upset in your life. What do? You're just going to shut down and hide? You can't have that. And I think, not to go into politics, but Matt, one thing, when I was younger, I remember someone came to my school. I'm not going to say who it is because it might upset people, but we had to go through metal detectors. There was a whole thing. And he was giving a speech, right? It ruined my whole day. I wasn't like, this guy shouldn't speak. I speak. I was just mad about that. I had to go through a metal detector.
Yeah.
I just thought everyone should speak. I thought the guy was a moron, but I wasn't I never thought he should not speak.
Right.
People think someone shouldn't say something.
Yeah, words are violence nowadays.
I don't get that. That doesn't get me at all. I mean, no. I remember when I was just everyone should say, you don't have to agree with them, but let them say something. And if it's comical, that's great. Then it's funny. But it doesn't, they all should have it. Everyone should have a chance. And you should remember that with your friends in business too. If you don't like someone's politics, you don't like their religion, you don't like anything, but if they're a great businessman, learn from that. You don't have to worry about the rest.
100%.
Don't worry about that. That's something for out of the work.
Yep. I love it. Anthony Scavo, thank you for coming on the show today, brother.
Thank you, Matt. Great interview. Thank you so much.